Actually, a very good question. It's not that complicated. As I'm not formally trained, I never learned how to use CompuStat and that sort of thing way back when that was difficult. So I basically read a lot. I read a lot, and I follow my nose. And when I have an idea, when I stumble upon something that might look interesting, I go right to the regulatory filings. The first thing to read for any company, in my view, is not a broker research report. No offense. It's the last 10K for the company. And then after that, you read the proxy statement and see how the board's structured and all that. On my Scion Capital website, which is defunct, I've got a few of my old letters, and I describe some of my process there. It's not too. I reject volatility as a measure of risk. I commit to ideas for the long term. Sometimes they work out in 3 months, and that's great. But you commit and you evaluate the thesis as you go along. Using filings, get on the. You want to read everything they file. That's where you know the company's telling the truth. I'm a sucker for charismatic people, so I specifically do not go and meet with the charismatic CEOs and CFOs and that sort of thing. For some reason, it doesn't. I'm a little bit more on alert in Asia. I don't know why. So I can go over there, but I never felt that it was really necessary for me to go and, there's that old line, how do you know a CFO is lying? His lips are moving. And, I've never thought that I could discern truth from fiction in that setting. However, reading. There's a funny story. When my first night on call as an intern, I was in the ICU. It was my very first rotation, and I was all alone, and I had this lazy anesthesiologist, senior resident, absent, and a patient needed an art line, and I had nobody to teach me how to do it. An art line, there's the veins. The veins, you pop a vein, nothing happens. You pop an artery, that's the thing that shoots the blood across the room. So, and you can if you do it wrong, the distal or if you do the wrist wrong, the hand will rot off. So, but I said, well, I've never seen one. I don't know how to do one, but I know she needs one, and I did one. I read the instructions and I did it. And then I had to do another one later that night, and I did it. And in medicine, they say, see one, do one, teach one. And that never worked for me. Even with procedures, I wanted to read it, and then I would understand it. And that's how I start my research in every case. And in almost every case, not in every case, but many times, the standard measures don't apply. Price to earnings ratios, price to book ratios, that sort of thing. In a lot of cases, I'll back into my own balance sheet and figure out what I need to know in terms of, a little bit of there's a special situations angle to a lot of what I do.
Dr. Burry, we have our best portfolio managers from across the country in the room today, so certainly portfolio construction is always top of mind. In the current environment, we're seeing that correlations between different asset classes are very high. So if it was you in such an environment, how would you go about constructing a portfolio with diversification in mind? And second part of that question is, what do you think is a potential catalyst that could lead to this high level of correlation between asset classes breaking down?
Well, I'm probably not the expert on this for any, my way of constructing a portfolio is pretty rudimentary. I try to keep positions less than 10%, that sort of thing. Try not to let it get too concentrated in any one thing. But I'm not, modern portfolio theory is not my specialty. I noticed that many assets correlate. The correlation's been very strong since 2003, and at times it's kicked it up into another level. among all assets, and that's important, and it makes the job harder, but it doesn't make the job impossible. I'll give an example. Coming out of the 90s, the Korean stock market index, I think it was 35% of the index was Samsung Electronics, and the index went nowhere for like 10 years, or right, like so 8 years. But Samsung went up many times, even though it was 35%. And you'd think that if anything would correlate with that index, it'd be Samsung. And it didn't, because the company was coming into its own in some new lines of business, new products and things. And so I think that the way I invest, I don't worry about all that too much. I think it makes it difficult, but I generally invest, like, my idea of a less risky portfolio is 15 positions, well-researched, 10 to 15 positions, well-researched. So maybe that's quite a bit different than what most people would say, but that's how I go about it.
Just saying that, your idea of portfolio risk in general is obviously very different from most